Well, hello, everyone. Welcome to our Silicon Global online show, our Ask a VC series. We've been doing the show for quite some time now, and we've had 65 episodes. You can check them out on our Silicon Global Online YouTube channel anytime you want. They're on there. And today we're going to be actually recording this show as well. So before we actually get to the Q&A, I'm going to introduce Morgan Flagger from Silverton Partners. He's based in Austin, and we're so happy he can join us today. He's part of our Texas series. We've been doing a Texas series lately, partly because of the Silicon Heartland connection, and Texas is part of that whole story. And so we had ATX, we had S3VC, and today Silverton. So thank you. You can check all these out on our YouTube series as well. A little bit about myself. I'm an author, I'm a journalist. I do these events. I do the Ask a VC series. I've written 4 books. We have a newsletter. We have a Circle membership. So we have all these things going. Here are my 4 books. The most recent one is Silicon Heartland. The first one was Silicon Dragon. So it's almost like a series here as well. Different geographies, different times. And pace keeps going. All right. So a little bit about Morgan as we get started here. Morgan is managing partner of Silverton Partners. He joined it in 2009, and he's been very actively involved. He's on the board of 10 portfolio companies at Silverton. He has a long history of investing and leading tech companies in Silicon Valley and Texas. He actually moved to Austin in 2006, and that's when his career really sped up. So we get to hear a little bit more about that. Before that, he was at FTV Capital as an associate for 3 years, and he's been a director at a couple of tech companies that were acquired. He's a graduate of Stanford University, and he grew up in Santa Cruz. So yeah, a real Stanford native there, Silicon Valley native there. Hi, Morgan, how are you doing?
I'm doing great. Thank you so much for having me, Rebecca.
Sure. Okay, and a little bit about Silverton as we get started. Formed in 2006, it's the most active VC firm in Texas. It's all about funding and mentoring startups. 7 funds, $1 billion assets under management. Currently investing from $177 million early stage fund and a growth opportunity fund, which is follow-on, $75 million. All about B2B software, fintech, AI. And we're going to be talking a little bit about some of his great deals. So I'm going to stop the share here, and we're going to go to Morgan and myself. And also, in about 20 to 25 minutes, I'm going to open it up to Q&A, and we have some questions kind of geared up here, but we welcome your questions. And so when you want to ask a question, you can put that in the chat box, or you can just turn your camera on and ask directly, and I'll acknowledge you. Okay.
Yeah, so I've been in Austin just about 18 years, born and raised in Silicon Valley before that, as you mentioned. So a lot of my, Silicon Valley specific experience on the venture side is a bit dated. But just to kind of rewind to kind of my decision to come down here. So I was a successful entrepreneur, joined 2 companies in the first 10 employees, Ingrian and Quintana, that both had outcomes, and then started a company called Whoosh when I was in the Bay Area. And then, as you mentioned, joined FTV Capital. It was a bit of a counterintuitive, I would say, decision to move from the Bay Area to Austin in 2006. It was long before kind of the last 7 or 8 years when quite a few folks have come down here. But the calculus for me at the time, from my experience doing venture in the Bay Area, was the best opportunities tend to accrue to a very small select group of firms. And oftentimes it's those special opportunities that create the disproportionate outcomes within the venture ecosystem. I think everyone's at least somewhat familiar with the idea of power laws and just how the venture ecosystem work, and how a very small number of companies kind of disproportionately produce the value. And so if you want to be good and make money in this business, obviously, like, you have to get access to those companies. That's the hardest thing to do. And then you have to make the right decision once you get access to make that
Yeah.
investment. And so at the time, Austin still had a tech ecosystem. It was much more nascent than it is now, but it didn't have kind of what I would describe as like a very top tier early stage venture fund that was serving the market. You had Austin Ventures, which my early partner, Bill Wood, had kind of co-founded and was a managing partner of for 20 years. They were definitely here and active in that ecosystem, but they had moved later stage in terms of their focus. At the time that I came down here, they were looking at buyouts, doing growth investments. They kind of strayed a bit from just doing the early stage investing. And the fund that they were predominantly investing when I was down here was $1 billion fund, which seems somewhat pedestrian or small, at least given the context of how much capital has been raised in venture over the past kind of 4 or 5 years. But at the time, that was a massive fund. And a lot of the seed investments were, 500K to maybe $3-4 million at that point. And so, investing $1 million or $2 million in a seed investment when your fund is $1 billion is a very difficult thing to do. You can't really put out the volume of capital you need to put out. So I kind of felt like there were some structural disadvantages to them kind of continuing to serve the early stage market. And thought that was an opportunity. So came down here, joined up with Bill Wood, as I had mentioned, and got started with Silverton with the idea of kind of creating that top tier firm to serve the Austin, Texas market.
Okay, so you talked about access to the market, and how difficult or how easy was it to get this kind of access in a new market for you?
Yeah, I mean, obviously it takes time. I had that shortcutted a bit through the relationship with Bill because he had been down here since '84. So he had basically predated me by, 20 years or so. And so he had a lot of the connections and kind of was able to link me in quickly after I moved down here. But I think the key thing that sometimes people forget, or I should say often people forget, is, venture capital it's a service business. And our customers are entrepreneurs. And a lot of people kind of sometimes think it's the other way around, like entrepreneurs should be catering to venture investors and that sort of thing. Well, the reality is it's the opposite. Like we don't have a business without entrepreneurs. Entrepreneurs have multiple sources of capital. They don't necessarily need VCs. I mean, obviously you can make the argument we play an important role, but certainly don't need us. And so if you're trying to court that audience, especially the best folks who tend to have a lot of choices, the way you have to do that is you have to be helpful. You have to treat people with respect. And then you kind of have to fulfill your role of really helping them, create the outcomes that they want to create. And so with that as like the guiding principle, you try to build your reputation that way, right? So be true to your word, really dig in and help roll up your sleeves and help people get stuff done. Don't be a jerk. All those sorts of things. And so as simple as that sounds, it's easy to forget sometimes. So kind of started with that principle. And then, if you get lucky or good or whatever you want to call it, enough to have like some really strong early outcomes. And I was fortunate enough to do that. Oftentimes entrepreneurs that want to work with people who have built big companies and had success in the past because that's what they want to do.
Yeah.
And so it's a bit of a flywheel or a ball rolling downhill or snowball rolling downhill. And so like once you get some of the successes, things get a bit easier. And I was fortunate enough to get that and have really kind of tried to keep that going. And then obviously we've expanded the firm over time to try to help more entrepreneurs and make Central Texas and like a stronger ecosystem. And we certainly can't take credit for the growth, or at least complete credit for the growth of what's gone on in Central Texas. But early stage capital is a huge component of that. You can't have big companies unless you start with small companies, and you can't have small companies typically unless there's some capital here to help get things going. And that's the role that we started playing back in 2006 when I came down, and I think we try to still serve that same niche of the market today.
Right. Yeah. So, well, that's good. I mean, I think it certainly has grown up quite a bit, and you've got a lot of competition now too. So, how do you work with these other VC firms that are also kind of trying to do the same thing that you're doing?
Yeah, I mean, a lot of people obviously that you immediately jump to, hey, competition is bad. It's like
Yeah.
harder to get the deals you want to get. And while there is obviously some truth to that, you know, to me, it's always really been about the ecosystem and kind of the growth of this environment as a place where entrepreneurs want to be. And I think one of the issues that Austin had when I came down here in '06 is there was really only one large source of capital, and that was Austin Ventures, the firm I was talking about previously. And so if you're an entrepreneur, you know, having a one or two firm town, like that's not ideal, right? Because everybody makes mistakes. Even the best firms are going to pass on great investments. If you talk to any venture person who's been doing it for any length of time and they tell you they never passed on something that they should have done, you know, they're
Mm,
probably lying, right? That list
yeah.
gets pretty long pretty quick. So as an entrepreneur, like even if you have a great idea, even if you make a great pitch, even if you do all the things within your control, someone could still make a bonehead decision and say no. And if you really only have one or two options, like that doesn't really make your odds really good about being successful in that market. And so, you know, now we're at the stage of Austin's development where maybe there are, I mean, depending on the exact type of company, there might be, you know, 6 to 10 groups or firms that, you know, might write that check. And obviously, if you look nationally, you know, that number gets bigger. And so that's healthier. And that means people want to stay here to build their companies. People want to move here from other places because they have a better shot at building their companies. And so when I say competition isn't bad and that, you know, having a strong community is really the most important thing, like that's kind of what I'm
Yeah.
referring to. So in general, it's been good. The growth has been good. It's been good for entrepreneurs, which is good for us. You know, of course, if, you know, we want to fulfill our mantra of being the best, you know, firm in the region, you know, we've got to get access to best deals and we got to do them. You know, that pressure never relents, no matter how successful you are. And so we'll always have it, but it's good. It makes you kind of stay on your
Sure.
game, makes
Absolutely.
you know, make sure you're giving people fair terms and all that kind of stuff. And I guess the other thing that I'd say, you know, about that is we do have a bit of a leg up because of what I mentioned, whereas, you know, people want to work with the folks that have done it in their environment with similar types of businesses in the past to what they're trying to do. And the longer you do it, and if you're doing it well, the more of those examples you have. And so, you know, we're a little bit more advantaged to compete than we were back in 2006 when our track record kind of wasn't what it is today.
Right. Well, 7 funds. So you have to have a good track record to get 7 funds, and each one successively bigger. So tell us about some of your success stories among the entrepreneurial companies you've backed.
Yeah, sure. I'd say probably the biggest outcome we've had in terms of like market cap value is a company called SailPoint.
Yeah.
Um, Made that investment really shortly after kind of I joined back in 2006. My partner, actually, Bill Wood, had the relationship with these particular entrepreneurs. But the reason why I want to use it as an example is, you know, we tend to be very team oriented in terms of like the types of deals we like to do. So some people talk about market or product, you know, those sorts of things. Those are obviously important, but by far number one for us is team. And just to kind of put a point on that, so when I first talked to Mark and Kevin, the founders of SailPoint, they were pitching a secure browser business. So they would sell to like financial institutions was kind of the core, you know, target market at the time. And they would sell them like, hey, if you want to access, you know, Wells Fargo or whatever, you got to download our browser, and that's going to cut out a lot of the, you know, phishing and malware and other things. And you know, if you care about your security as a consumer, like you're going to want to download our secure browser. And by the way, you can't really use it for a lot of other things, but you can use it for this. And so I listened to that pitch, and I'd come from FTV, which was called Financial Technology Ventures, and all of our LPs at the time were banks and other
Oh,
financial institutions. And I knew the challenges that presented themselves with what they were trying to do. So the business itself wasn't like the market or product wasn't that interesting to me. You know, but Bill spoke super highly of the founders. They had been involved with a company called Tivoli that had gone public and then been acquired by IBM at the time. I think it was the second largest IPO or whatever. So they were credible folks. And he said, hey, look, like if it isn't this, like these guys are going to figure it out. And as it turned out, it wasn't that. So, they raised money, from us, they meandered along trying to make this work for about a year, realized it wasn't happening. And I remember the board meeting, they're like, hey guys, like, I know you gave us money to pursue this, but, we're going to go do something else. And so they, I wouldn't even call it a pivot. I would call it just a pure, complete restart. So they
Wow.
decided to start with identity management. That was something that was kind of analogous to what they had done in the past, built the business up, and obviously it became a multi-billion-dollar public company, recently taken private. And so that's one example of the team kind of like, pivoting, realizing what was working, figuring out what they needed to do, having the conviction and confidence to go to their board and do a complete 180 on what they were
Yeah.
doing, and then, make it happen. And there were other things along the way with that team, like their tenure kind of was over the great financial crisis, 2008, 9. That was a terrible time to do business, worse than now. Now isn't a great time for a lot of tech companies, but certainly worse than now. And like, I remember them coming to us. And again, this wasn't something we drove with them. They came to us and they said, hey, we're having trouble, meeting budget. We're going to actually take a salary cut, and we're, the whole senior team is going to take a deeper cut. And then the whole organization is going to take a little bit of a smaller one. And what we want to do is we want to compensate people with equity, so every dollar you forgo in salary, basically you reinvest in the equity of the business at a predefined price. And they kind of came to us with this methodology, how they were going to make the cash plan work. And we kind of helped them on the margin kind of make that work, and they did it. And, honestly, like, had they not done that, I'm not sure if the business would have worked,
Wow.
right? And
How
so
many?
you have
Yeah.
multi-billions of market value that were predicated on them having the conviction and foresight to force that through the organization and to get people excited about it and keep the team together.
So how many years was this that you were with them, investing in them and continuing to recommit?
Yeah, so I think we completed 3 financing rounds with them. So I think seed through B was kind of like, where we were investing.
Yeah.
We were the first investor, and then the other rounds had other investors in them, and we were kind of participating. And then they ended up selling to Thoma Bravo, like a good portion of the company before they went public. We didn't kind of participate in that financing, but quite a while. I mean, I think our entire tenure with the company was like 10 plus years.
Mhm. So there was another company that I think was hugely successful for your firm, Alert Media.
Yeah. And another example of like investing in people, that's still a private company, majority owned by Vista now, but that was another one we kind of wrote the first, check into, with an amazing founder, Brian Kruber. He had a prior company called Zenex that did basically light-based sterilization. So it wasn't at all related to Alert Media. Alert Media was like a software business that does emergency management and notification. But his first company was enormously successful, very focused entrepreneur, knew how to build a team, was putting a decent amount of his own capital kind of behind the business. And so it was easy to get excited about it. And even though I think at the time we invested, the company had maybe a couple $100,000 in revenue, it certainly wasn't something where the success of the business was written on the wall. It was easy to get excited about working with Brian, and just kind of helping him, make the right decisions, bringing the right investors. I think we introduced the folks that led the later rounds, helped bring in 2 or 3 early members of the exec team. And I'm still involved with that company today. In fact, we had a board meeting this morning that I attended. And the company's doing great. And whether they go public or, have $1 billion plus outcome is still kind of TBD, but it'll likely be one of the 2 of those scenarios. And just a special feeling when you get to be involved from that stage early on through, that sort of exit, and how much change there is in a business over that period of time.
Well, sure. I noted that a number of your portfolio companies have been acquired. A couple of them have gone public, but it seems like more than half have gone, been acquired by major companies. So that's kind of interesting that is there something about the Texas market that lends itself more to acquisitions? Because I in Silicon Valley, I hear more about going public. Is that kind of a difference that you're seeing between Silicon Valley and Austin that would lead
Yeah,
to
I mean,
these
I think
kind of
it's more just like,
acquisitions?
yeah, sorry to interrupt. Yeah, I mean, I think it's more of like what gets airtime, right? So I
Okay.
think more companies are being acquired. Well, in fact, I know more companies aren't being acquired in Austin that are being acquired in Silicon Valley. But obviously IPOs tend to be the bigger outcomes, and those are kind of what people like to talk about.
Yeah.
Percentage wise, which may have kind of been where your question's at, like does Austin have a higher percentage of businesses being acquired? Like I actually don't know the answer to that. I mean, I would say like as a firm, like our loss ratio is a little bit lower than the industry average. So like, typically 20 to 30% of the businesses that we invest in per fund end up not returning capital. They don't all go out of business. Sometimes they are acquired. It's just a low number. For most seed funds, that's typically like 50 to 55%. So maybe we have some special sauce or some goodness around who we choose to work with. I think the one thing that we do maybe a little bit better is how we allocate capital. So we don't tend to like to write huge checks up front. I mean, we've done that on occasion where it's required, but that isn't kind of our default behavior. Like we like to give people enough capital to really solve whatever the next risk item or is in front of the business. So like early on, if we're investing in pre-revenue or pre-product, it's getting your first customers. If it's getting your first customers at the time that we're investing, then it's how do you have a repeatable, efficient go-to-market motion, or how do you build out the executive team? And so we like to capitalize the business, kind of like just enough to achieve the next stage of success or risk, mitigation, I guess. Because, as disciplined as people are, like the more capital that's sloshing around on the balance sheet, the easier it is to kind of be not as disciplined and overspend here and overspend there because the
Yeah.
repercussions of that aren't as immediate.
Yeah.
And we've seen a lot of that, right? Like
Sure.
2021, probably like the banner year of like raise as much as you can possibly get at the highest possible price and figure it out later.
Right.
That really isn't how we tend to operate. And I think it kind of goes back to early days Austin, like when I was starting out here coming from the Bay Area. The Bay Area has always been kind of more awash in capital than probably any other place. And when I got here, I was a bit surprised because I'm like, it's harder to raise a Series A or it's harder to raise a Series B here than it is in the Bay Area, just because the concentration of firms and that sort of thing. And so we kind of had to be cautious and pragmatic and make sure that the unit economics were working and make sure we had kind of all the boxes checked. And so once you kind of have that background as far as like, this is how you do it. And, even though the market changes, like Austin's gotten easier over time, you kind of never lose that early DNA of like, this is how you make sure you kind of get it done right. So maybe that explains a bit of it.
Yeah.
Well,
Yeah. No, also, you mentioned that now is not the best time for tech companies. And maybe you're thinking about the valuation situation. Well, what were you thinking of when you said now is not the best time for tech companies?
yeah, I mean, if you look at, the broader kind of market, like the NASDAQ, especially this year, but in general has performed okay. And so a lot of people look at that and be like, oh, well, tech is doing great. And I think the reality underlying that is it's really a very small number of companies within tech. I would say like sub 10 that are driving a lot of that appreciation in the stock market. And the broader tech landscape, especially on the private side, is suffering a bit. So like if you look at categories like enterprise software,
Right.
growth rates have come down every year from 2021.
Mm-hmm.
Valuations obviously are still down from 2021. Renewal rates have gotten worse from that period of time. So it's harder
Mm-hmm.
to get new customers. It's harder to retain customers. And there's this artifact of what happened in 2020 and 2021 that's still kind of affecting a lot of people, where they did raise a lot of money. They probably raised it at a high price, and now they have to deal with, do I take a down round? Like I had these investors who had different expectations for my business when they
Right.
invested. How do I manage that? Are they going to allow me to go out and raise money at half the price? Is that going to be a super dilutive event? And so it's really the combination of all those things, I would say, that make it a little bit more challenging of a time. Like, I still think the great financial crisis, and the dot-com crash from a business climate perspective were probably a little bit worse than what we're seeing now. But with the great financial crisis, you didn't have this huge run up in tech. Like, you didn't have 2021 right before that happened. You had a pretty moderate tech environment. And so when you have a huge run up and then this kind of bad business environment, that's what makes it a bit tougher.
Right.
Just because you got to, right size your burn, and then you have all the other artifacts of like larger rounds and investor expectations. So those things definitely add a complication to it that I think a lot of private companies are struggling with a bit now.
Right. So one of the things that's been kind of interesting about what's been going on in the market is how much these companies have raised, and sometimes they raise too much, right? And then they have to figure out how to manage all that money, and how to grow. And so I think that this is something that you can address very well, and tell us, I mean, how do companies actually figure out how much to raise and when to raise it?
Yeah, I mean, it's interesting because there is like a social aspect to like the perceived success of your business. And
Mhm.
a lot of times some of that currency is like, well, how much did you raise? And like, what price did you get? And, that's how people kind of measure themselves against each other. It's like, oh, well, my
Right.
business is more valuable than your business, or I was able to attract more capital than you were able to attract. And so I think we saw some of that in the 2020, 2021 timeframe, where people were kind of trying to outdo it, each other on that time, in that time frame. And then also people's perception was like, well, what's wrong with having $100 million on the balance sheet? Like, isn't that kind of like universally a good thing? And I
Right.
get it. Like, it can be counterintuitive, right? That having $100 million isn't always a good thing.
Right.
And part of why that might be the case, right, is whoever gave you that $100 million, right? Like, they have certain expectations for what the business is going to do and what they need to do to get their returns. And people are driven by like whatever goals they have. And so they're going to push you in a way that's going to give them the best chance, or at least their perceived best chance of
Right.
getting that outcome. And if you're an entrepreneur, the idea of, hey, this is worthless to an investor if it doesn't sell for 2, 3, 4 billion dollars. You might be in a different spot, right? You might be like, hey, like, this, all my net worth is tied up in this, and I've spent the last 7, 8 years of my life, and all I want to do is, have a $200 million outcome, right? Or a $50 million
Yeah.
outcome, and I can make some money for myself. And I think what people don't realize always is like, sometimes they take, or at least they make those outcomes difficult if they don't take them off the table completely by accepting more capital and the expectations that come with that. And then the other thing that's a part of it, which I kind of talked on briefly, which I won't retread on, is the more capital you have, the easier it is to be inefficient, right? And
Right.
more capital spent inefficiently is a difficult thing to overcome, because new investors, especially right now, are going to look at it and be like, all right, well, it took you $50 million to get to 5 million in ARR. Why is the next 10 going to get you to 20? Right? Like, you've kind of proven you've been inefficient, and that's a drag on you. Kind of now telling investors, well, things are different now, right? Because there's this this predating set of facts. And although like it's certainly not a hopeless situation, it isn't a good fact to have spent a lot of money and not done a whole heck of a lot. It's something you have to overcome. And so, all those things kind of make an entrepreneur's life potentially more challenging when there's enough to think about, when it's just growing revenue and keeping customers happy. You don't also need to think about like crazy investor expectations and and all these other things.
Well, what kind of tech companies are you investing in right now? I know your firm has done a lot in software, business to business software, and I know you've also done some AI infused companies. What kind of companies are actually, on your radar the most? Tech companies.
Yeah, I mean, it's certainly going to sound cliche to say, but like if you were to pick one broad category, and it's more of a technology than it is, even a category. But like AI is probably like the top thing on our list right now. It's probably like 40 to 50% of the deals that we're doing have like a strong bent that direction. And it's across like different elements. I mean, how I would describe it is what is possible now with AI that completely couldn't have been imagined or couldn't have been possible before. Like that's one category of investment we make. And I'll give you some examples of some recent things that we've done in these categories. Another one is, hey, the category exists, but the introduction of AI fundamentally changes that category to the core. Like that's a disruptive technology. That's interesting. And then the other thing is kind of more like the second order effects of AI. And so like one example of that might be like we have a company that we're going to announce shortly that's basically allowing publishers to license their content and really content creators, publishers, a wide variety of people to license their content efficiently and monetize it to like LLMs of various shapes and sizes. So like, is that a AI company? Like I would say, like not really. It's more of like an API, like infrastructure company. But it's a second order effect of like, hey, now you have these voracious models out there that need as much content as possible in the newest thing and the most current information. And then you have all these publishers that are used to people going to their websites and viewing ads that may stop or slow down, where people are like just going to models and doing search that way and not necessarily going to individual websites. So they need to make money off their content in a different way than they have before. And so like all those things are super interesting to us.
Yeah, this may actually be a really good outcome for publishers, digital publishers that have been struggling financially, from the print to digital transition. And now maybe the AI era will help them, because I was just reading, I think today or yesterday, about News Corp is going to be licensing content to OpenAI, I think. So, that they're going to get money from that.
Yeah, I mean, be careful what you ask for. I mean, it's definitely too early to tell whether it's positive or negative, but I'd say the fact out there is you have to find a way to capitalize on this opportunity to license your content and make money from it. Like how you do that in a way that ends up with more money in your pocket than 3 or 4 years from now than was the case last year is a good question, right? Because just because you license content doesn't mean you're going to have more revenue 3 or 4 years from now when your traffic's down 50%. It depends on how that license is structured and how you get paid and whether that's enough to compensate you for a slowdown in visitors. But that shift is happening real time right now, and certainly putting your head in the sand and expecting it all to go away isn't a good strategy. Like that train is moving down the track.
Right. That's good. So there's a question from our chat, and the person wants to know if you have any investments in the Internet of Things area.
Internet of Things. So we have one that basically was like sold. It wasn't a successful investment. It was called Nuve. And it basically was in the shipping and logistics area and was part of like trucks and other delivery containers. It would signal if they were like tampered with or modified. In some cases, it measured like the climate of those things if that was important to the delivery of those investments. And it would also monitor like fuel caps and stuff on trucks, because in some countries like Africa and Mexico, people will actually like steal fuel out of trucks. And so it would not allow like, or in some cases it's fraud where people are like selling or stealing that stuff because it's an inside job. So we did make that investment. It didn't end up, working out for us in a way that I would say is meaningful. I can't think of another like recent IoT investment
Okay.
we've made. We're certainly not sour on the category. It's just not an area that we've invested in recently.
So your lead categories, your three lead categories right now are?
So if you look at the portfolio, we're probably 55-60% like enterprise software, which is a hugely broad, growth category. We do a lot in identity management and security and other things within that category, some, shipping logistics stuff as well. The next biggest is internet marketplaces like B2B and B2C. And then we have some direct to consumer and fintech investments. And then the final 10% or so is kind of a catch-all category. So some business services, we've done some hardware stuff in the past. We've done 2 CPG companies, but mostly software.
So, and this is because you have all of these great universities that are spinning out engineers in Austin, or why is that? Why so much B2B software, enterprise software?
Yeah, I mean, because of our focus, like on Austin, Texas, about 70% of our capital goes to work within the state of Texas. We tend to be a bit of an example of like what's going on in Austin in terms of portfolio construction. So
Yeah.
like if you look at like the early days of Austin, it was a lot of enterprise software, right? So you had, I mentioned like Tivoli, right? Like, the largest kind of systems management business at the time, like that was back in kind of the mid 90s. So that has started, SailPoint and like 5 other businesses, Waveset, et cetera. And so once you have a core set of folks that have expertise in a certain area, like that just kind of continues on and on over time.
Yeah.
So enterprise software has always been like the largest category of investment here. I would say overall across the entire tech ecosystem, enterprise software is also the largest like single category of investment. So I don't think Austin is super unique in that area. Consumer internet and marketplaces. So, we also had companies like, HomeAway and, Vacasa, and now like newer companies like Zebra and other things that are more consumer marketplace businesses. Drilling Info, more of a B2B marketplace. So that's where that kind of set of expertise kind of came in. We also have a medical school. And so we've done 2 or 3, like I would say more health tech oriented investments as kind of Austin has broadened out and is doing more stuff in that area. And it's interesting, like a lot of those companies that we're investing in have a strong software bent, even though they're health tech businesses, because data is such an important part of that ecosystem now, from drug discovery and all the rest of it. So, so that's an interesting category that didn't exist, within Austin, at least in a meaningful way, 7 or 8 years ago, that does now.
Yeah. So would you say that Austin has kind of diverged from Silicon Valley over time, or has it become more similar?
I don't think Austin has changed in terms of like investment focus,
Types,
has
yeah.
really changed that much relative to Silicon Valley over that period of time. I mean, I'd say the only category of investment that you would just never really find here, that you would find in the Valley, is a bunch of like this, like super like ad supported or user generated content supported consumer businesses. So, Google, Facebook, like those style of businesses that require a lot of capital and are more user activity traffic centric than they are monetization centric in the early
Yeah.
days.
Mhm.
I really don't think many of those businesses are started, period, outside of Silicon Valley. I'm sure there are some, well, I can think of like an example or two, but for the most part, like, Silicon Valley kind of has a lock on that particular business style. But like most anything else that you find anywhere in the venture ecosystem, like Austin's going to have some of that nowadays.
A lot more semiconductors these days too, with Samsung moving in and yeah.
Yeah, I mean, I'd say Austin is top two or three semiconductor. Unfortunately, from a venture standpoint, it's been a difficult category to invest in for a bunch of reasons I won't get into, but everything's cyclical, right? So like, semis was in favor in the 90s and maybe early
Yeah.
2000s. It's gone out of favor for quite a while. I'm sure it'll be back in favor at some point soon. And when it does, we'll be
Yeah.
there to invest in several of those businesses. But yeah, it's been a more challenging area to invest in for, I would say, the past like 10 or 15 years.
Okay. Well, there's a really good question here in the chat box about what advice would you give overseas entrepreneurs who are looking to set up in Texas, particularly in the B2B space?
Yeah, I mean, there's been several examples of folks that have moved here, moved their
Yeah.
businesses here, whether it's their US headquarters or just overall worldwide headquarters.
Yeah.
It's very central to the US, so it's easy to get to the West and East Coast.
Right.
It offers an interesting mix of skills. So you have like the software
Right.
semiconductor, which is critical, but you also
Hmm.
have like cheaper cost of living. So if you're a company that also requires like some manufacturing or a cheaper labor pool, you can also find that here, whereas you're not going to find that in Boston, New York, or San Francisco. Like one example of a company that did that was one of the first companies I looked at when I moved to Austin was BigCommerce. It's an Australian founded business. Moved here, was successful, went public. They've had a bit of a rough go of it in the public markets. I actually passed on that business. I shouldn't have. They did very well. But the two founders of that business, I think moved here right after I joined, like 2007 or 2008, still retain like development operations in their home, Australia. I think they're just outside Sydney. There's a recent company that we looked at, also didn't invest in, but has had success here in Austin that was a South African business. So yeah, I mean, my advice would be, if you want to move your business to the US, Austin's an excellent choice. There's a lot of capital here. There's a lot of things to like. It's going to be hard to raise capital without being on the ground here. So I would say come on down, whether it's a full-time move or like, hey, I'm going to go give it a shot for 6 or 9 months and try to raise capital. If I'm successful, I'm going to move everybody else out here. But I would urge you to go for it. And I don't know if we can put my contact information like in the chat or
Yeah, in the chat. Yeah,
pretty
you can
easy
put
to
it in the
find.
chat.
So we'd be happy to look at those businesses. Like we're an early stage investor, so writing $1 to $10 million checks typically in businesses that are sub 4 or 5 million in revenue. So I don't know if your company applies, but if that's you or you're a bootstrap business, would be happy to chat.
Okay. Yeah, Addie, maybe you could put the contact details in here in the chat box for people who want to, ask more questions later on. Are there any additional questions while we're here on the Zoom? Let's see, let's do a round robin. Who has another good question for Morgan, directly or in the chat box, either one?
Yeah, I have a question if you can hear me all right.
Yeah, just fine. Uh-huh.
You just mentioned that it's tough to raise capital if you're not, in Austin on the ground, at least among like the Austin, capital markets. I was just wondering in like the age of, obviously we're here on Zoom and whatnot. What makes it so important to be like in the city where you guys are?
Yeah, I mean, I was more reacting to the question. I mean, a lot of people that immediately like their first thing is like, hey, I'm looking to move somewhere to do something. It's kind of usually because wherever they are isn't conducive to whatever they're trying to do. So like most people's default mode of operation is, hey, I'm gonna try to raise capital wherever I am. And then if I'm unsuccessful there, maybe I need to pick up and move and go someplace like to raise capital. So I was more thought, hey, that person's probably in that bucket where they're not being satisfied within the context of their environment. Yeah, I mean, in general, obviously, like whether I tell someone they need to move, really depends on where they are. I don't think moving is necessarily like required, obviously, to raise capital. If you're overseas, and you're super early stage, like it is a hurdle to overcome because a lot of people don't like doing seed investments 5,000 miles away. Like they don't feel like they can keep good tabs on those investments. The time challenge is an issue. A lot of times recruiting team members is really important for early stage businesses. And like I don't know a lot of people in Denmark or whatever that I want to stick in early stage businesses, but I do know a lot of people in Texas. And obviously teams can be remote nowadays, but I don't see a lot of teams where it's like, hey, the CEOs in Denmark and the CTOs in Austin, just because of the similar like time frame communication constraints. So yeah, certainly not a requisite to co-locate on any of that stuff, but certainly can be helpful on the margin.
Yeah, what about Asia? I've been seeing a lot more connections between Austin, Texas, and Asia, Hong Kong, Singapore in particular. When I spoke at South by Southwest earlier this year, there was a lot of talk around that. So are you doing anything in Asia, or are you investing in any entrepreneurs who've moved to Austin from Asia?
Yeah, we've invested in a couple of folks that have moved here from Asia. I mean, sometimes it's directly, like, hey, I just moved here from, Hong Kong or whatever. Oftentimes, it may be like, hey, I moved here 6 years ago. Maybe I went to New York and then COVID happened and I came to Austin and now I'm looking to raise money for my business. So it's certainly been an increasing percentage of folks that we look at that are from other places. I mean, the other connectivity is we have a lot of folks that have strong business relationships or partnerships in Asia. We have a lot of folks that have outsourced development in various places in Asia. Within semiconductor, obviously there's a lot of expertise over there, and because of a large number of things, people are looking to have more of a U.S. manufacturing presence and potentially even like make the U.S. the headquarters of their business. So they're on the right side of some of the things that are coming down from the government. So it's definitely been a large increase over the past few years, but still the vast majority of like people we fund, I would say like 75+% for sure are Americans.
Okay. That's a very welcoming, very friendly market there in Texas and in Austin. You could feel at home pretty easily. I think people are very friendly with one another. It's not like a standoff kind of place.
Yeah, it's got some of the Southern hospitality thing going.
Yeah. So I noticed you have a very nice space there. Is that your office?
Yeah, we office out of like about 120-year-old house here in downtown Austin. So we're a bit non-traditional. There is a slogan in Austin, which is like, keep it weird. And I don't know if we're living up to that or whatever, but we like it here.
All right. Do you open that up during South by?
Yeah, we generally like host events here, as well as other places in town. We have like a quarterly get together called Bags and Brews, where we do kind of like a backyard party of sorts, which is here at the office. So we definitely try to kind of endear ourselves to the community. I did notice there was a question around like opportunities in payments or fintech.
Okay.
So yeah, I mean, here's the kind of skinny on that. So we've had a couple of, I would say, pretty successful like fintech or insurtech investments. One's a company called Self, which has well over 1 million customers. It's a credit building platform. Another one's called the Zebra, which is an online marketplace for auto home insurance, predominantly auto, I would say. It's been a tough time, right? So like interest rates going up, generally like difficult economic environment for like, I would say like subprime or kind of lower end US consumers. Like on the higher end, it hasn't really been of income levels. It hasn't really been felt this, the economic environment hasn't been felt as negatively as it is with some of those categories. And like, those are areas that a lot of the fintechs that we're seeing are serving. And so it's been a headwind for those folks. It was also like an overcapitalized area during 2021, as I'm sure most people know. It is absolutely a category that we're actively looking at and investing in. Payments has been a little bit less affected because, you know, people are still paying for things, and, you know, taking a scrape on payments generally tends to be a pretty resilient market. So I'd say that's been less affected. But the reason why I say I'm super interested in seeing those ideas is, hey, when you have a business that can show successful unit economics and good growth in an environment that has as many headwinds for like things in areas of fintech as we're seeing right now, like all those, you know, everything's cyclical. Interest rates will go down. Consumer health will improve at some point. We could all argue about when that's going to happen, but it will. And when it does, those headwinds turn into tailwinds. And so if you're making progress with a headwind, those tend to be disproportionately awesome businesses once the tailwind starts. And so where we see things that are making progress now, we love to invest in them. So
Okay.
certainly interested in seeing those ideas if there are folks in the audience that have them.
Well, another question from our chat here. What's your favorite part about being a VC? And a second question, what are your 3 best advice for someone seeking VC funds? So kind of a 2-part question.
Awesome. Yeah, I mean, the first one is really easy. So for me, you know, I mentioned, you know, things like, you know, SailPoint and the success we had there. You know, when you meet entrepreneurs, I'll give you another example. Like, we funded a company, it was called Sparefoot at the time. It's now called Storable. It's also a multi-billion-dollar business. But I met those guys when they were 22 years old. They had just graduated from UCLA. We signed a term sheet in a bar that's about a block from the office here. I have that picture, and it was really those 2 guys and a technical kind of co-founder, I would say, that were in the business at that time. You know, and now they dominate kind of the self-storage industry from a tech standpoint, payments, insurance, et cetera. Knowing how far that business has come and how amazing of a journey those entrepreneurs have been on, and how, you know, it's changed their lives, it's changed the lives of all their employees, having a front row seat and, you know, maybe even helping out with that business. Like, I can't imagine anything more rewarding than that. You know, it's kind of like the American dream or American ideal of hard work and success and innovation, like working. And I've been lucky enough to have, you know, a lot of examples that look like that. And so like, that's definitely what keeps me going, is just like, who's the next, you know, Chuck Gordon and Mario Fagali, who are the 2 founders of Sparefoot, and how amazing is that going to be to have the opportunity to work with people like that. And, you know, so it's like, you get amazing people, you get access to that, you get the appropriate incentives in place where, like, if they're successful, they're disproportionately, you know, kind of rewarded. And like, those 2 things kind of bring out the best in people. And so having a front row to that is just, yeah, that never gets old.
That's great.
The best advice for someone seeking VC funds. So, you know, obviously, like, listen to the feedback you're getting from investors as far as like what they're looking for. I would say, like, listen, but don't take it as gospel. Like, VCs are just people. They make mistakes. Sometimes they give you bad advice. Someone tells you your idea is stupid. Like, you know, you don't necessarily have to believe that. If 99 out of 100 people tell you your idea is stupid, maybe that's worth listening to. But like, definitely some of the best ideas don't have consensus. So listen to what they say, and then basically, like, you know, drip market and feed them the progress and information, like, as it's flowing out of the business. And like, keep people in the loop as to what's happening. And make sure that the passion that you have as an entrepreneur for the mission, for what you're trying to accomplish, like, comes forward. And whoever you do end up selecting as a venture investor, like, make sure they share that passion, at least at some level. Like, they may not express it in the same way, but if they're not a believer and they're just looking at like CAC LTV and these metrics and those metrics, and they have no fundamental like passion for the underlying thing, like, to me, that's a bit of a red flag. Not that those other things aren't important. But you really want someone to align with you and share the same vision and be wanting to row the boat in the same direction. And then the only other thing I would say is like get the best people you can possibly get around the business. Like I mentioned, like our number one criteria is the quality of the team. And if you can hire, even if you have to give up equity and even if you have to kind of jump through some hoops to get some awesome people, like there's nothing that's going to enhance your chances of raising money from a venture investor other than having other awesome people around the idea.
Well, that's just really excellent advice. And thank you so much, Morgan. I think we were all extremely enlightened by all your remarks, and really appreciate your time here today and really appreciate the good questions from the audience. Thank you for your attention. And if you missed any portion of it, we're going to be putting this on YouTube soon on Silicon Global Online. And I'd also like to thank our VC series sponsor, which Ask a VC, for Invest Hong Kong. And Silverton, thank you very much for your support and your time and attention for this wonderful show. So we're going to be signing off now because I think we've reached our hour and it all goes so quickly. And thank you, Morgan. Any final words from you?
No, I really appreciate all the great questions. And I wasn't kidding for those in the audience that do have something they want Silverton to look at. I think, Addie also put her contact information in the thread. Reach out to us. We're happy to interact with you. And if you have any other questions, we'll do our best to get back to you on that as well. But thanks for having me.
Okay. All right. Well, take care. Have a good evening.
All right. Thank you. Bye.
Bye-bye.